Welcome to the Explainer. Today, we're basically playing financial detective, and we're digging deep into the Q1 2026 financials of the Belgian semiconductor heavyweight Melexis NV. Now, if you follow the European tech space, you already know Melexis is a massive player, especially when it comes to automotive semiconductors. But lately, a really fascinating gap has opened up between the market's pricing and what independent analysts are screaming from the rooftops. It's your classic valuation paradox. So today, we're going to strip away the noise and look strictly at the raw numbers, the assets, and the internal management incentives to figure out what's actually going on behind the scenes.
Right, let's jump straight into it. Independent analysts over at Simply Wall Street are looking at the exact same data we are, but they're slapping a big overvalued label on the stock, pinning the fair value at €71.92. And this is super intriguing because Melexis's own narrative is completely different. They're heavily pushing this story of faster revenue expansion, wider margins, and a booming earnings base down the line. So we've got this premium market valuation colliding head-on with a very clear data-driven warning flag. And the big question we have to ask ourselves right off the bat is simply why? Well, why the overvalued tag? It boils down to three critical vulnerabilities that are seriously threatening their premium pricing. First up, sky-high inventories. That puts massive pressure on their pricing power. Second, a stubbornly slow end market recovery. Let's be real, if the broader automotive or tech markets are dragging their feet, Melexis feels the pain immediately. And third, the looming risk of volumes just falling short of expectations. It's a classic high-stakes tightrope walk of supply and demand. If they're sitting on too much product and the buyers aren't there, that whole premium valuation story, it could unravel really fast.
To figure this out, here's our roadmap for today's Explainer. We'll unpack the valuation paradox, break down the actual Q1 2026 profitability, dive into the cash flow and assets, look at how management is actually getting paid, and finally, navigate the latest rules on their dividends and taxes.
Okay, moving right along to Section 2, the Q1 2026 profitability breakdown. Let's look at the hard numbers. Let's see how the actual income statement holds up against those analyst warnings we just talked about. What's genuinely interesting here is how resilient the top line actually looks at first glance. I mean, they still pulled in €202.1 million in sales for the quarter. And sure, that is a slight dip from the $214.5 million they managed in Q4 of 2025, but it's actually an increase compared to the $198.2 million from Q1 of the previous year. So the top-line revenue isn't exactly falling off a cliff, right? It's holding relatively steady year over year. But as any good investor knows, sales are really only half the story.
The really crucial data point is this earnings per share number, €0.57 for the quarter. That was driven by an 11.4% net profit margin, ultimately leaving them with €23.1 million in actual, cold, hard net profit. But hey, look closely at the trend. That 11.4% margin, that is actually down a full percentage point from the 12.4% margin they had back in Q1 of 2025. So while they are absolutely still profitable, the cost of goods sold and their operating expenses are quietly taking a slightly larger bite out of every single euro they make. It's a subtle squeeze for sure, but it's a super important one to keep in mind when you're trying to justify a premium stock price.
Next up, Section 3, cash flow and assets. Let's visualize what's happening on the balance sheet. Because, numbers on an income statement are great for showing what happened over a 3-month sprint, but we need to see what the company actually owns and owes to grasp its true structural health. Diving into their reported assets for Q1 2026, the total assets are sitting at a very healthy $851.2 million. On the surface, wow, that looks like a massive, rock-solid foundation. But remember, we're acting as financial detectives today. We can't just glance at the bottom line of the asset column and call it a day. We need to dissect it. We have to zoom in on two specific current assets to really understand that inventory risk the analysts are sweating over. And boom, here it is. This perfectly validates the early warning signs we were talking about. They are sitting on a staggering €292.2 million in inventory, compared to just €37.1 million of actual cash. I mean, let that sink in for a second. Nearly €300 million of their capital is literally tied up in unsold chips and raw materials just gathering dust in warehouses. If that end market recovery stays slow, converting that giant mountain of inventory back into usable cash without slashing prices aggressively is going to be a monumental headache. But wait, don't let that relatively low cash balance fool you into thinking the business is gasping for air. We need to look at how they are generating and deploying their money on a day-to-day basis, because the story there is actually incredibly strong. Breaking it down, despite all that bloated inventory, operations generated a fantastic €92 million. After taking out a modest $10 million for capital expenditures, that yielded a highly robust $82 million in free cash flow for the quarter alone. And what exactly did management do with that windfall? They were aggressive. They took $70 million of it and paid down debt. So the takeaway here is that while a ton of capital is locked up in inventory, the day-to-day operations are a literal cash-generating machine, and management is using that machine to aggressively deleverage and clean up the balance sheet. Moving to Section 4, Management Targets and Pay. Time to follow the incentives. Honestly, whenever you see aggressive financial maneuvers like that, generating massive cash and wiping out debt at breakneck speed, you always have to ask, how are the executives making these calls getting compensated? Let's follow the money. According to their 2025 remuneration policy, management's variable pay is heavily weighted toward the present moment. A full 50% of their variable payout is tied to short-term performance. That means the current financial year. Midterm and long-term performance, those only make up 25% each. This structure practically forces management to prioritize immediate financial results and efficiency right now, today. And their exact motivation is crystal clear. A massive 60% of that short-term bonus payout is tied directly to EBIT, that's earnings before interest and taxes and revenue growth. So what does this mean for our big valuation paradox? It means management is literally banking on keeping profits and sales as high as possible right now. Their own paychecks rely on pushing those $202 million in sales and maintaining healthy margins, which perfectly explains their intense laser-like focus on operational cash flow and efficiency, even with those inventory risks looming in the background. Finally, Section 5, Dividends and Tax Rules. Let's look at that crucial DTCC notice. All right, we need to shift gears to something highly practical. If you're a retail investor holding this stock, maybe you got drawn in by that sweet $2.40 dividend per share, there are some strict, newly outlined tax hurdles you absolutely must know about if you want to protect your returns. Back on May 21, 2026, the Depository Trust Company, or DTCC, issued this urgent official notice regarding the Belgian withholding tax applied specifically to Melexis dividends. Because the company is based in a foreign jurisdiction, international tax treaties and local withholding laws kick in, and Melexis is definitely no exception. So here's the bottom line. By default, all holders of the depository receipts are going to receive their dividend minus a massive 30% Belgian withholding tax. Yeah, 30%. That is a huge chunk of your yield just vanishing into thin air before it ever hits your brokerage account. But there is a silver lining. You can get this back. However, it requires you to actively file what's called a long-form reclaim. If you want that tax money back, you cannot just sit back and do nothing. You have to follow these precise steps to prove your identity and your business registration to GlobeTax, which is the entity handling all of this. Individual investors, you need to provide a copy of your identity card. Legal entities, you've got to provide VAT numbers and business registrar extracts, and definitely mark your calendars. You have until the October 31st, 2030 deadline to get all these submissions finalized. But seriously, the sooner you navigate this bureaucratic maze, the sooner you actually reclaim your full dividend yield. So that brings us right back to our central paradox. On one hand, we've got a company sitting on a massive, risky, $292 million pile of unsold inventory in a really uncertain end market, which is exactly why analysts are screaming that it's overvalued. But on the other hand, they are an absolute cash-generating machine, pulling in $82 million in free cash flow in a single quarter, aggressively paying down debt, and being steered by a management team that is directly financially incentivized to keep earnings sky high. So with all these puzzle pieces finally laid out on the table, I'll leave you with this to ponder. Do the actual operational numbers and cash flows justify the stock's premium valuation today, or are the analysts right to issue a warning about what's lurking in those warehouses?